Hey guys, so in this lecture we're going to learn about the 9:30 a.m. trading strategy. Bear in mind it works the best with indices, for example NAS 100, S&P 500. Okay, it does work with forex as well, but I would recommend that you stick to indices with this trading strategy. Okay, so first of all you want to change your time zone to New York. Okay, and then you want to trade. You can only trade between 9:30 a.m. till 11:59 a.m. New York time. Okay, so this is your window period. Okay, you can only trade within these hours. So this is the very first rule of this trading strategy. Okay, the second rule is you want to identify some sort of liquidity. Okay, so you want to identify some sort of liquidity between these hours. Okay, and or you can start looking for some sort of liquidity at 9:25 a.m. Okay, you can take trades after 9:30. Okay, so let's say if okay, I'm gonna explain it later, but you want the rule number 2 is you want to identify some sort of liquidity. Okay, and the rule number 3 is you want to wait for price to sweep that liquidity. Okay, so you want to wait for price to take out the liquidity, okay, that you have identified. Once the price sweeps out the liquidity, you want to wait for market structure shift. Okay, once price takes out the liquidity, then you wait for market structure shift. And now there are two ways to enter. Okay, you can either take the entry from the first fair value gap, or you take your entry from the extreme fair value gap. So what I mean by that is, let's say this is liquidity, right? So this is the 9:30 open, right? This is where, for example, okay, the 9:30 time starts from here, and you have this liquidity zone, equal highs, day of the high. It could be any sort of liquidity, okay? So it could be equal highs, it could be a major swing high or a swing low, it could be a daily high, daily low, or previous day high, previous day low. It could be a weekly high, a weekly low. So any sort of liquidity, okay? And then you wait for price to sweep the liquidity. Okay, and once the price sweeps the liquidity, or actually when you spot the liquidity, you want to go down to the 1 minute time frame. So you are looking for liquidity on a 15-minute time frame. Okay, keep this in mind. You have to look for liquidity on a 15-minute time frame. 15. Okay, and once you have spotted the liquidity and the 9:30 starts, you go to the 1 minute time frame, you wait for price to sweep out the liquidity, and then on the 1 minute time frame, this is how the price is going to look like, right? Price sweeps the liquidity, and then you wait for market structure shift. So this right here is a market structure shift, as you can see. Now before the price breaks this structure, there would be some fair value gap here, and the extreme one here. So you can either take your entry from the very first fair value gap, okay, but you gotta keep your stop loss up there. So, and there's another option, that is you take your entry from the extreme fair value gap. Now what would happen with this is, if you take your entry from the extreme fair value gap, you're gonna get a higher risk to reward trade. Okay, but if you take your entry from, let's say, the very first fair value gap, you're gonna have a bigger stop loss, but you're not gonna miss a trade. Okay, so sometimes if you have your entry at the very extreme fair value gap, you're gonna miss out the trade. So I would say that stick with the extreme fair value gap, because it's okay to sometimes miss the trade, as long as you're getting the trades with big risk to reward trades, and it's going to cover up the missed trades, if that makes sense. So here's the thing: when the price sweeps the liquidity, you want to wait for market structure shift, and then you enter at the fair value gap, and you target some sort of fair value gap here. Or I go by this rule: when I take my entry and I have my stop loss, I go for minimum risk to reward 3, and I can go for maximum 5 risk to reward. This is all I go for. Okay, I do not chase big risk reward trades because you know, there's so much going on in the world right now, and I do not want to hold my trades for a longer duration. So yes, we have, then you can either take the entry from the first failure gap, or you can take your entry from the extreme failure gap. So I'm going to give you guys some examples, and it's going to be crystal clear to you guys.